Hello and welcome to the Professional Trading Masterclass video series with me, Anton Creel, ITPM Managing Partner. So guys, you've arrived at the PTM video series. What a video series we have in store for you. Whether you're here because you're a retail trader looking to get to a more professional standard, or you're actually an individual who is looking to go into the industry and literally become a professional trader, this is where it's at. This is by far the most comprehensive education in trading you will ever get. So guys, this is what we're going to do. We're going to get straight into it. We're going to introduce you to three major concepts straight away. We're going to be looking at the framework of the Professional Trading Masterclass video series and the framework that we're going to use throughout the video series. And the three main areas we're going to introduce you to straight away are the competency hierarchy, time horizon and volatility, and the Pro Trader systematic framework. So guys, we will learn those first, and then we're going to look at the most important thing. And this is going to take up the bulk of the PTM video series. It is the trade idea generation process, okay? With the trade idea generation process, we always start with fundamentals. We live in the majority in our trade idea generation process in fundamentally driven trade ideas. This makes up the vast majority of what we do, and it makes up a huge amount of the Professional Trading Masterclass. We are rooted in our fundamentals in both quantitative and qualitative processes. And this is what we call the discovery and evidence phase. It's a combination of both top-down macroeconomic processes and bottom-up company level or stock fundamentals. Next, we move on to trade timing, how we time our fundamentally driven trade ideas. This is in the minority of our process. We use technical analysis and price action indicators to time our fundamentally driven trade ideas, okay? We don't use technical analysis and price action indicators to actually generate the ideas. This is a major difference between professional traders and retail traders. Our trade ideas are rooted in fundamentals. They are driven by fundamentals, and we use technical analysis and price action indicators only to time our trades. Then later, much later in the video series, we are going to be looking at catalysts, okay? So for our time horizon and volatility optimization, we operate in the 20 to 60 day time horizon. And we do this in equities, okay, in the stock market. So this provides us with a very large opportunity set. It gives us wholesale opportunities and a systematic process within this time horizon and within equities. This mandate gives us consistency, which is the holy grail for traders. We want to get consistent, outsized returns. So our trade ideas are fundamentally driven trade ideas that are timed well. We want to be operating within that 20 to 60 day time horizon. We are not investors, we are traders, and we require catalysts for a stock to actually move within that time horizon. So there'll be much more on this way later in the video series. In the meantime, we have a lot of work to do on the trade idea generation process. After that, we have what we call in the whole process, the whole systematic professional trader process, we have trade structuring. So what we're going to do in the PTM video series is actually assume that we're only going to have long and short stock positions. The PTM video series is not an options trading program. For trade structuring, if you want to learn how to structure trades using options, you have to take the Professional Options Trading Masterclass, okay, the POTM video series. Learning how to trade options and how to structure your trade ideas using options is an entire class in itself. It can't be done in the PTM video series, okay? Now, next step of the whole professional trader systematic framework is risk management. And this splits up into two areas. We have preemptive risk management and we have reactive risk management. So preemptive risk management will be taught in the PTM video series. However, there's an issue here with risk management. Unfortunately, reactive risk management simply cannot be taught in a video series. Why? Because reactive risk management involves actually having a position, and when you've got a live position, knowing what to do at any one moment in time in a specific situation that's specific to a particular stock. Unfortunately, retail traders, it's a bad habit. Retail traders do always look for rule books and checklists for everything to do in every specific situation. This is not how it works, okay? So unfortunately, reactive risk management, you have to actually go to the next stage to learn reactive risk management. It can only be taught with live positions, and at ITPM, this can only really be taught on a trader mentoring program. So we will cover preemptive risk management, which is all the preemptive steps that you can take before you actually have positions when building a portfolio. So the best practices of preemptive risk management. Next up in the whole pro trader systematic process is our trader metrics. How do you actually measure your performance as a trader? We're going to show you how to calculate a track record in a professional trader way. It's not just about making money for professional traders. Of course, that's a large part of it. It's also about how you make your money. Also, in this video, we're going to introduce you to the ITPM principles, the 4 ITPM principles, which we're going to be utilizing all the way through the video series. These are self-sustainability, work ethic, free information, and working smart and not hard. So guys, we're going to get into this video now, the framework, the whole PTM video series. There's many parts to it, many major parts to it, but the first 2 major parts of the PTM video series, we're going to be covering the pro trader systematic process, which involves top-down and bottom-up fundamentally driven trade idea generation. But first, let's cover the framework that we're going to be using in more detail so you understand how professional traders go about things. This will form the basis of everything we do going forward in the video series. So guys, let's get stuck into it. Okay, everybody, welcome to the computer screen and welcome to the Professional Trading Masterclass video series. Let's get started. We've got a hell of a lot to get through. It's a huge, huge body of work and there's a lot of stuff to learn. So let's start. Video 1, the framework. Let's start with a little background. Let's get some context about ITPM, the Professional Trading Masterclass. Let's try and understand the bigger picture here, okay? So, the Professional Trading Masterclass, the first version, the PTM 1.0, was launched in May 2013, and it was available from May 2013 to May 2020. This video series is the second version, the Professional Trading Masterclass 2.0, which has replaced the PTM 1.0 in May 2020 and launched in October, November 2021, okay? Now, in terms of content for the PTM 2.0, the PTM 2.0, it's not simply an updated version of the PTM 1.0 with some, say, more recent examples. It's a total overhaul of the video series. And roughly, it's about 2.5 times more educational content to help retail traders globally get even better than they were before. What we've included in this video series, the updated version, is everything that we've learned as professional traders by interacting with retail traders over the last 7 years. And that essentially is a big attempt to improve the PTM video series even more. Now, going way back to May 2013, when we launched the first version of the PTM video series, the trading education industry globally was a total mess. And to a large extent, it still is. When the first version of the PTM was launched and the ITPM really came into global existence, we essentially set a new standard by raising the bar massively in the trading education industry. And since then, guys, we've really helped literally thousands of retail traders to become profitable globally through the original PTM video series and our 12-week trader mentoring programs. Now, also, we have our YouTube content, our YouTube channel, and that's been online, up and running since 2013 as well. And that hasn't just helped thousands of retail traders, it's helped millions of people globally change their approach to financial markets and to trade better, okay? When the PTM 1.0 version launched, the original version, when it launched, it set everything in motion. What it did is massively raise the bar and go global, okay? We took ITPM global and we literally changed an entire industry, okay? We changed the industry for the better. What are we doing now? Well, we've decided to raise the bar again with the launch of the PTM 2.0. And we totally aim to succeed in moving the industry again into uncharted territory. From now on, guys, the PTM 2.0 will be known and referred to as the PTM, the Professional Trading Masterclass video series. Now, in terms of prerequisite knowledge, what do you need to know before starting the PTM video series? Well, you can come in with a blank slate. That's totally fine. But most of you coming here right now, before taking the PTM, you will have taken the Introduction to Professional Level Trading, the IPLT video series. It's not an absolute necessity to do before you start the PTM. But if you haven't completed this program prior to starting the PTM video series, it's definitely advisable that you do. Why? Because you'll get a far better understanding of the concepts, resources, and teachings of the PTM video series if you do that first. Now, if you're coming here and you have completed it, the IPLT video series, congratulations. You've definitely made a giant leap forward in your trading education. There's definitely not many retail traders on the planet that have acquired the knowledge that you have and the understanding of financial markets that you've now got. You are already in the minority of retail traders, the significant minority of retail traders. And as we go through the PTM video series, you're just going to get better and better and better, okay? But for those who haven't taken the IPLT video series, and also for those who have, let's just have a quick recap on the key teachings and key knowledge of the IPLT video series before we plow ahead into the PTM. Okay, so what did we cover in the IPLT video series? What did we conclude? Well, we found that the approach to financial markets taken by pro traders is totally misunderstood by retail traders for multiple reasons, okay? Secondly, retail traders are kept what we call unconsciously incompetent by the market players that have inherent conflict of interest, okay? Who are those people?
retail brokers, and charlatan trading educators. Quite frankly, and this really just sums up the whole industry, there is a whole industry. The entire industry is built around keeping millions of retail traders incompetent. Third, what else did we learn? In emulating the professional trader approach, we learned in the IPLT video series that we have to attempt to emulate the function of hedge fund managers or the old investment bank proprietary trading function, but within the bounds of the retail trading industry infrastructure and the parameters of volatility that are set by the market. Okay. On volatility, what did we learn? Well, volatility is both risk and opportunity, which means it's everything to a trader. Okay. Volatility is the most important thing for a trader. We have to understand the methods of how to calculate volatility properly. And we did that in the IPLT video series by calculating distribution of returns, average true range percentage, and implied volatility. Those are the methods, and we calculated it in the same way that professional traders do it in order to understand its implications. Why? Because these are the methods that professional traders use. Okay. Once we know how to calculate and understand the implications of volatility, we have to know how to exploit it in the same way that professional traders do. And from the lessons of volatility, we learn how to exploit it because we learn the areas that are the most consistent and the most profitable. Okay. So we end up with concluding that building long, short, 1 to 3 months equity and equity options portfolio for absolute return is the best area of the financial markets. And this is where professional traders exist. So for students who took the IPLT video series, this is genuinely a recap. But for those who haven't taken the IPLT video series and have come straight to the PTM video series, we definitely advise and encourage you to do the IPLT first. If you haven't, it will put into context everything in the PTM video series. And what it really does is it shows you and puts into context why we actually teach what we're teaching in the PTM video series. So if you're actually going through the PTM video series and you keep asking yourself the question, why am I learning this stuff? Why is this important? Well, the IPLT video series puts that into context. Now, we also learned in the IPLT video series how to apply the competency hierarchy. And for those of you that are new, the competency hierarchy can be applied to any learning endeavor, whether it's, for example, learning a new language or perhaps learning a new skill like driving, or even, for example, learning a new profession. So, for example, becoming a chef, becoming a plumber, an electrician, even becoming an entrepreneur, and even becoming a trader. Okay. So we have 4 levels to the competency hierarchy: unconscious incompetence, conscious incompetence, conscious competence, and unconscious competence. So in the 4 areas, we split up into 2 big areas. We have incompetence and we have competence. Okay. And if you look on the right-hand side, you look right at the bottom at unconscious incompetence. In any setting, learning any new skill or endeavor, unconscious incompetence basically means you've got no clue what you're doing, but you think you do. And this is an area that's full of delusion, denial, and lies. In the context of the retail trading industry, that's where retail traders exist. Okay. So professional traders exist at the top of the trading industry and retail traders exist at the bottom. Okay. Let's climb up the competency hierarchy. What's the next level? Well, conscious incompetence. We're still in the realms of incompetence, But the person now has the right information. They know that they're doing it wrong. They have the right information, and that information is going to enable them to learn and potentially apply the skill set, okay? But they're still incompetent. But they're climbing the hierarchy because they're now conscious, okay? In the retail trading context, okay, this means that you've learned that all the things that you used to do don't work, okay? And the reasons for that, and you're starting to climb the hierarchy. You've started to become conscious, okay? That is now you getting your hands on the right information, okay? And this is basically the IPLT video series and the PTM video series and subsequent video series at ITPM. Next in the hierarchy is conscious competence. And this is where people sit in endeavors and skill sets that they're learning when they actually know how to do it right. And they're doing it in the real world and practicing it, doing it over and over again. They're implementing the knowledge that they've learned, okay? In the trading context, this is when you move from theory to implementation. This is where you take what you've learned in theory and you start to apply it and implement with real money, okay? And again, this can't be done with demonstration money, guys. This can't be done in demo accounts, okay? Trading and becoming competent at trading, it has to be done with real money. It can't be done with fake money, okay? It can't be done in a spreadsheet. It has to be done with real money. So this is you over a period of time implementing the right knowledge and doing it with real money, okay? And then we come to the level of unconscious competence. What does that mean? Well, it means you've been doing it for a good amount of time. You have a statistically significant amount of trades that you've done. You have the metrics that prove that you are competent, and you're now doing it on repeat, and you're not thinking about it too much. So in the trading context, this would mean that you're essentially a professional trader level. Now, of course, professional traders are regulated by regulators. They've passed their professional exams and they're trading with either investor money, or if they're trading at banks, with shareholder money. The skill set itself doesn't mean you are regulated. You can still learn all of the same skills and apply it in a retail trading infrastructure. But if you are unconsciously competent, where you are essentially taking the right information, you've traded over a period of time where you've got a statistically significant amount of trades, and you've got the trader metrics, and you're now doing it on repeat. You're not thinking about it too much, and you're just getting the numbers over and over again. What does that mean? Well, it just means you're the level of a professional trader. It means you're good enough, okay? Now, where do institute traders sit? Well, institute traders sit in between conscious competence and unconscious competence. Institute traders are competent, and they've either been doing it for a while and they're doing it on repeat, and they are essentially professional traders but operating within the retail trading infrastructure. They are professional trading standard, but they're not registered or regulated as professional traders. Or they're sitting within the ITPM infrastructure. They're trading, they're new to it, they're going up the competency hierarchy, or maybe they've been there for a while and they're stuck around conscious competence. And these guys, they may need mentoring programs because something's going wrong. They need to have a pro trader on their shoulder to fix their problems, to get them into unconscious competence. So institute traders kind of sit between the two. They're either in one or the other. But for most people coming here now, you're either going to be, unfortunately, at the level of unconscious incompetence or conscious incompetence. If you've taken the IPLT video series, you've definitely started to climb out of unconscious incompetence. That information should absolutely awaken you to the fact that everything you've been doing before is wrong. And now you're getting the right information. So you should be sitting on the fringes of the two. So either just climbing out of unconscious incompetence and sitting on the fringe of conscious incompetence, or sitting somewhere in conscious incompetence. The PTM video series is the right information. The IPLT video series is the right information. If you complete the PTM video series, your next step is climbing out of conscious incompetence into conscious competence by actually implementing the information. But let's go through a textbook guide of what the competency hierarchy looks like in the trading context. What do retail traders have to do in order to become long-term, consistently profitable traders? Because in the IPLT video series, we learned that if we're going to emulate professional traders, we absolutely have to do what they do. And what they do is they are consistently profitable over a long period of time. So what do retail traders have to do in order to get consistent profitability? Well, retail traders, the vast majority, and we're talking 97, 98, and 99% of retail traders, will forever be sitting at the level of unconscious incompetence. How do you get out of that level? Well, you've got to drop your old ideas. You cannot even begin to climb the competency hierarchy unless you recognize that the old ideas you had do not work. Of course, you may have experienced some fleeting successes. Everybody tends to have wins occasionally, okay? Even when sitting in the unconscious incompetent level, okay? But overall, you're going to lose over many trades over a long period of time. That's because you're not taking an approach that's sustainable, that allows you to get consistency. So the actual professional approach, the approach that professional traders take. If you climb out of unconscious incompetence and you realize that, you're in conscious incompetence, okay? You are actually learning the pro trader systematic processes. You now understand the difference between the two. You now understand that sustainability in trading means consistent returns, which can only be achieved through a robust and repeatable systematic process. You know you have to learn the theory of how professional traders select their trade ideas, time their trades, structure their trades, and build portfolios and manage risk both preemptively and reactively. You understand that you have to learn it and you acquire this information. Then and only then can you move on to conscious competence. So you become conscious and you start to become competent. And how do you start to become genuinely competent at trading? Well, you trade with real money. You implement the processes, the theory that you've learned. You have to properly commit to the process that you've learned and implement the processes in a live trading account with real dollars. Demo accounts do not count. You have to achieve reasonable returns over a number of trades over a period of time. And at this stage, if you do have difficulty over a time period bridging that gap between theory and implementation, you have to seek professional mentoring. Otherwise, you're just not going to be able to jump to the level of unconscious competence. When you're working on your weekly schedule, this endeavor, this skill set, it has to be repeatable and sustainable. The hours that you put in, the hours that you commit, and the quality of work that you output, it has to be repeatable and sustainable. That is also how you become consciously competent. So you have to commit to the process, implement with real money, and it has to fit into your life seamlessly. When you've got those things and you've done it over a period of time, that's when you start to move to unconscious competence. This is when you are on autopilot mode. You're not just implementing profitably and doing it consistently. You're now doing it without thinking about it too much. It's not stressful. It comes naturally, okay? What happens? The management of your trading account and the growth of your account and the weekly processes that you adhere to regularly become natural. You're generating high quality trade ideas on a weekly basis. You completely know how to build and manage your portfolio successfully, and you do it naturally and with ease. You also know what to do when things go right. You know what actions to take when things go wrong, and you're taking all outcomes in your stride in a very low stress environment. You're essentially the same standard as a professional trader, but you're existing as retail. Okay, so now that we've got some context, we're going to move into the framework now. What is the whole point of ITPM? What is the whole point of our programs? What are we trying to do here? What is the point of the IPLT video series, the PTM, the POTM, and the PFTM video series? What are we trying to achieve? What's the objective? Well, ITPM, we're here to provide a framework that allows retail traders to emulate consistently profitable professional traders so you can benefit from the same approach. We're aiming to make retail traders consistently profitable through a framework, but the framework has to allow retail traders to utilize the same approach that's taken by consistently profitable professional traders within their own retail brokerage accounts. Okay. There's no point in learning the theory if you can't implement and do it with real money. Okay. So we're trying to make this real. It has to be implementable by retail traders in the retail trading infrastructure. The framework itself has to allow retail traders to implement the process from the framework on a weekly basis and realistically how they can fit this endeavor into their normal everyday lives. So your first step, once you've actually admitted to yourself the wrongs that you've been involved in, the first step is to learn the theory. The good news, obviously, is that you're here already, which means you're on your way. You're climbing out of unconscious incompetence and you're sitting nicely in conscious incompetence. ITPM can take you all the way. However, the video series that we have, the IPLT, plus the PTM, plus the POTM, and the PFTM, our video programs can only get you to the door of conscious competence. You have to step over the line yourself into unconscious competence, okay? Or if you can't do that, your option is to get a boost from a trader mentoring program with one of the professional traders at ITPM. But if you think about the hierarchy and you think about our online programs, for you to get out of conscious incompetence into conscious competence, that requires some practical things. Setting up a trading account, depositing money in the account, generating trade ideas, putting trades on, structuring the trades, and building a portfolio. And doing that over a period of time, over a number of trades, that makes it statistically significant. Okay. To get out of conscious incompetence, to move into conscious competence, what's required? Well, you're going to have to complete the online programs, the IPLT, the PTM, and the POTM as an absolute minimum. Okay. And then you're going to become competent. That's when you move into competency. And you're doing it for real with real money. Okay. You've got the right information and now you're doing it with real money. You're conscious. To get to the next level, to unconscious competence, it takes a period of time, quite a long period of time, and a number of trades to become statistically significant. So these are our objectives. Okay. This is what we're setting out to achieve, to get as many retail traders as possible to emulate consistently profitable professional traders, to benefit from the same approach, and using the framework and processes on a weekly basis and realistically fitting that into their normal everyday lives and getting you up the competency hierarchy right to the top of unconscious competence. So this is the objective, and these are the objectives of ITPM. Okay. So the framework itself, how do we actually go about achieving this? Well, we are traders. We are not investors. What you are looking at here is a chart of time horizon and financial markets volatility. If you look at the chart and you look at the number of days across the top, where we start on the left-hand side with 1 day, 5 days, 20 days, 60 days. And then we go all the way out to 120 days, 250 days, which is one financial year for trading, because there's 250 trading days in a year, 750 trading days, 3 years, and 1,250 trading days, 5 years. Okay. So we're looking at trading days in terms of our time horizon. And traders exist on the left-hand side. The longer we extend our time horizon, the more we become investors. Okay. Now, this is where the problem lies for retail traders, because retail traders always mix up trading and investing. The time horizon constitutes what you actually are. It defines what you are. Okay. So retail traders, because they don't really know the difference between trading and investing, what do they end up doing? They end up doing a mix of both, whether that's in the same account or in multiple accounts. As their overall strategy, what retail traders tend to do is they either exist all the way on the left, okay, or all the way on the right as retail investors. So it's quite funny, when we have our applications for mentoring programs, we actually ask people what books on trading they've read as one of the questions. And most people, the vast majority, most retail traders, when they apply, when they're filling out that question, they're telling us what they've read, and all the books that they have read are to do with either day trading or it's to do with very long-term investing, either income or value investing. Okay. And there's nothing in between. So retail traders genuinely don't understand out there in the big world that there's an entire world that's in the middle. There's an entire world that's between the classic time horizon of trading, which is very short term, and long-term investing. And it's called long-short portfolio management. Okay. The problem that retail traders have is that they're either one or the other, very short-term traders or very long-term investors. They don't know anything in between. So what ends up happening? When retail traders are trading, they're trading 1 to 5 days, most of the time as day traders. What are they doing if they're trading very short term, especially as day traders? They're competing with algos. They're competing with software that can do tens of thousands of trades in a second, and they're trying to compete against them for returns. It's not even possible anymore, guys. It used to be 20 years ago, maybe up to 15 years ago. It isn't anymore. Okay. So this is a zero-sum game. We prove that in the IPLT video series. Or retail traders become retail investors. They go all the way to the other side. What are they doing? They're reading books on income and value investing, which haven't worked for decades. And they're buying cheap stocks in the hope that in the next 3 to 5 years, they're going to turn around. It's a hope strategy. And guess what? They have to sit for 3 to 5 years to find out if they're going to be right or wrong. That isn't what a trader is, guys. That isn't what a trader is. Traders are not investors, okay? Where do professional traders actually sit? Okay, well, professional traders, the vast majority, are sitting between the 20 and 60 day time horizon. So we are 20 to 60 day long short portfolio managers. Okay, that's what modern traders are. When we go into positions, we are going into them with the aim of making money in the next 20 to 60 trading days. Okay. And we know that if we keep a position on beyond 60 days, slowly but surely, the position starts to become an investment. And that is the cardinal sin in trading. When a trade becomes an investment because you haven't taken off the position. Okay. We want things to happen in the 20 to 60 day time horizon where we have the consistent volatility, where we have the volatility sweet spot. The longer we keep on a trade beyond 60 days, the more it becomes an investment. Now, there's a gray area between 60 and 120 days where the gray area trades start to become investments. Beyond 120 days, a position is absolutely at this stage an investment. Okay, so you've had a position on for 6 months or more. It absolutely is an investment. In between 60 and 120 days, it's slowly becoming an investment. So morphing from a trade into an investment. So we do have this gray area, but the vast majority of times, professional traders are trading in the 20 to 60 day time horizon. If anything's on for more than 60 days, it's highly, highly questionable. That person is probably falling into bad habits and is becoming slowly an investor. Okay. We don't want that. We are not investors. We are traders. Now, from the IPLT video series, when we looked at volatility, what does it mean for long short portfolio managers who exist in this time horizon? Well, it's the area of the market that provides wholesale opportunities and wholesale opportunities that have the volatility that enables us to harvest continuous, consistent, expected return. Okay. That's why we exist in this area. What happens when volatility moves? Well, it's adaptable. The process and the framework is adaptable. Okay. When volatility goes up, we move from being portfolio managers and we slide down the time horizon and we become more short-term traders. When volatility declines, we slide up the time horizon and we become more portfolio managers and we trade and we build long-short portfolios. Okay. So it's adaptable. The framework is adaptable to our time horizon and volatility. But the vast majority of times, around 80% of time, possibly up to 90, we are existing in the 20 to 60 day time horizon. Now, the beauty of what we teach here at ITPM and the beauty of this approach is that we are existing in the volatility sweet spot, and therefore we're learning in the volatility sweet spot. What does that mean? Well, if you're in the 20 to 60 day time horizon, you are learning in the majority about fundamentals. Our trade ideas are fundamentally driven, and we use technicals and price action for timing only. Okay. So what are we doing? We are learning the best disciplines of fundamentals and the best disciplines of technicals and price action. Okay. So we're learning the best disciplines of investing and the best disciplines of trading. Now, what does that mean in the bigger picture? Well, from a learning perspective, this is the best area to learn, to climb up the competency hierarchy. Why? Because If you learn the best areas of fundamentals and you decide later in your career you want to become more of an investor, well, you will slide up the time horizon, and the other stuff that you've learned here will help you become a better investor because you'll have learned the fundamentals, but you won't be bad at timing your investments, okay? Because you've learned all of the other stuff. You've learned the best disciplines of trading as well, okay? And what happens if volatility increases? Well, if volatility increases or you want to become more of a trader later in your career, of course, you can slide down the time horizon to shorter term trading, and you will become a better, sharper end trader because you've not only learned the best of trading content, you've not only existed as a trader, you've also existed building long short portfolios and your trade ideas being driven by fundamentals. So it will sharpen your trading. You'll become a better trader. Long short portfolio management in the 20 to 60 day time horizon is not just the volatility sweet spot. It is also the learning sweet spot for retail traders and, in fact, all traders. So in terms of the framework that we're going to be teaching you here in the PTM video series, we are going to be teaching you how to trade in the 20 to 60 day time horizon, how to build long short equity portfolios in the 20 to 60 day time horizon. And we have a process for building the portfolio. We have a process that we go through to build the portfolio and to trade the portfolio, okay, in the 20 to 60 day time horizon. And we can split this entire process up into theory and implementation. Let's start with theory. This is the vast majority of what you'll be learning, okay, in the PTM video series. We come up with trade ideas, okay? We are generating trade ideas on repeat, okay? It's the most important thing you will do, the most important thing you will learn. And we learn this in the PTM video series, okay? The trade idea generation process is rooted in fundamentals. Our trade ideas are fundamentally driven, okay? And the trade idea generation process is split up into two main parts: the quantitative process and the qualitative process. We will cover this in the PTM video series, okay? Next up is timing. Once you've come up with a trade idea and you believe that it's a trade idea that you want to put into the portfolio, that's when we have to time our trades, okay? We have to use technicals and price action to essentially time our trade ideas. Now, what's the percentage split in terms of information and effort that we put in when we end up with a position? What drives it the most? Fundamentals or timing? Absolutely fundamentals. This is 80 to 90% of everything we do in the trade idea generation process, okay? If you've been told in the past that technicals and price action are the methods for generating trade ideas, unfortunately, you've been taught by a person who has never been a professional trader. Professional traders absolutely, in their overall systematic process, have the majority of their work done in fundamentals. Their trade ideas, in the majority, are fundamentally driven. Technicals and price action are tools that are only used to time fundamentally driven trade ideas. We do not, under any circumstances, use technicals and price action indicators to generate a trade idea and then in the future use fundamentals to justify why a position went right or wrong. That's for amateurs. That's for idiots, okay? That's for unconscious retail traders. So professional traders, we are 80 to 90% fundamentally driven, and we are 10 to 20% technical and price action driven, but The technicals and price section are not generating the idea. The idea is fundamentally driven, and then we use technical and price action indicators and tools to help us to time the trade better. Okay. Now, this is all theory because it's a lot of research. It's work. You're doing research to generate the trade ideas. Okay. That's actual desk time, and that's work that you're doing, research that you're doing to generate trade ideas. That's the vast majority of what you'll do. Okay. Next up is trade structures. Why? Because we're looking at catalysts. Before we have a position, we need to look at catalysts and decide what trade structure we're going to have. And that isn't necessarily just going long or short a stock. We can utilize options. And more often than not, there will be option structures that are more optimal than being long or short a stock, given the catalysts that are coming up in the next 20 to 60 days. So when we're implementing, which is the big area over here, where we're now trading with real money, so implementing everything on the right-hand side, when we're implementing, we're choosing our trade structures around the catalysts that we forecast. Now, of course, once you end up with a position, there is risk management, okay? And risk management splits up into two areas: preventative risk management and reactive risk management. We will come on to this much later in the video series, but just understand and appreciate the basic framework for now. The key message to take away here is that in the trade idea generation process, which is the most important part, okay, the vast majority of the work we do is fundamentally driven. Our trade ideas are fundamentally driven. But there is a bigger overall definition of what constitutes a trade idea. So what are the differences between, for example, a day trade or a short-term trade, an investment, and an actual long-short portfolio manager trade idea? Okay. Well, let's have a look at day trades first. What are you doing when you generate a trade idea? When you're trading in the time horizon of 1 day, where you're going to come in the morning, you're going to be flat. And when you leave at the end of the day, when the market closes, you're going to be flat as well. You only have positions in the 1 day time frame. Well, you're going to be basically scalping what we call order flow. So orders that are in the markets that are moving stocks up and down in very short windows of time. And you're going to be trading on candlestick charts, which are minute to minute. And you're going to be using technical analysis and price action indicators 100% of the time. There's no fundamentals in the 1 day time horizon. So it's just going to be trading on very short-term indicators and very short-term news flow. So basically a lot of noise and hunches. Okay. What about an investment? Well, we've mentioned this earlier. It's going to be 3 to 5 years based on fundamentals. Of course, it can be growth as well as value, but there's a problem. You have to sit around and wait for 3 to 5 years to find out if you're going to be right or wrong. Now, what about something that's prevalent in the market from retail traders in recent years? The you only live once retail trades. Those can be both short-term positions, so 1 day to 1 week, and they can also be investments where you're basically fully subverted to a narrative that an investment is going to go up by thousands and thousands and thousands of percent over a 3 to 5 year period or longer. And you just keep that trade on as a YOLO trade, as an extremely high percentage of your account and or net worth. And you're all in. You're essentially all in on the position. So it can be 1 day to 1 week, or it can be an investment. Now, when we compare this to long-short portfolio manager trade ideas in the 1 to 3 month time horizon, what's the definition there and what's the differences? Well, the differences are very easy to spot. Okay. If we look at what it actually is, the long-short portfolio manager in the 1 to 3 month time horizon is utilizing fundamentals in the vast majority, but also using technicals and price action. So we're 80% fundamental, 10% technical, roughly, and 10% roughly price action. But that's not where it ends. A trade idea, the definition of a trade idea, includes other things, okay? It also includes having catalysts within the 20 to 60 day time horizon, the 1 to 3 month time horizon. It also includes coming up with what you believe to be is the optimal trade structure in the 1 to 3 month time frame. And it also involves risk management, both preventative risk management and reactive risk management. So some sort of plan in terms of risk management on the trade idea that you're going to implement prior to having the position, and also a plan to exit, whether it's going to be a winner or a loser, how you're going to react when the stock moves, okay? And also how you're going to react to certain catalysts if they come out. So this is what you're going to learn in the PTM and the POTM video series. The implementation phase can be either done by yourself, okay? It can either be done by yourself inside or outside ITPM. So of course you can complete the PTM video series. You can do additional video programs at ITPM, and you can choose not to become an institute trader. You can choose not to implement inside the institute infrastructure. That's fine. That's totally fine. Everyone is an individual and everyone has individual circumstances and choices. If you do come into the ITPM infrastructure, you'll be implementing the program content in real time with real money. Okay. But you can also opt for a 12-week mentoring program, followed by doing it yourself, or you can do a mentoring program up front. That's totally fine. We're very flexible. But the implementation phase, you do it yourself, either inside or outside the ITPM infrastructure. But essentially, regardless of the infrastructure that you're operating in, you will be in the larger context in the retail trading infrastructure, and you're going to be implementing the trade idea generation process, which is 80% fundamental, 20% technical and price action. It's going to include catalysts, include trade structuring and risk management. Every trade idea has to have all of those elements. Otherwise, it just simply isn't a trade idea. Now, what about the largest part of the overall process? The trade idea generation process. What about that part where we're looking at fundamentals? Let's have a look at that because it's important to understand the details of the framework. Earlier, we looked at in fundamentals being rooted in a quantitative process and a qualitative process. It's by far the biggest and most important part of the overall professional level trade idea generation process. It's the discovery phase of the idea, okay? The discovery phase of the trade idea. And that is a combination of quantitative and qualitative processes and assessment, okay? We mentioned previously, we are minimum 80% fundamental analysis and maximum 20% technical analysis and price action when generating trade ideas, okay? We do not pull up a chart, draw some meaningless lines on the chart, and then look for some superficial fundamentals to justify why we happen to have the long or short position, or using those fundamentals to explain afterwards why we had a winner or loser in the portfolio. So we begin with a really thorough top-down analysis of macroeconomics. And we combine this with a bottom-up fundamental analysis in order to generate long and short biases for the overall stock market, for sectors, and for individual stock picks. Now this, when we're talking in this language and talking about these definitions, don't worry about it too much, but you're going to learn all of this stuff later in the video series. But understanding the basics here of the framework, we're looking at combining top-down analysis and bottom-up analysis, so macroeconomics and microeconomics, to obtain long and short biases in assets, okay? And those assets are the overall stock market, equity sectors, so industry sectors, and individual stocks within those sectors, okay? We'll come on to this in great detail across the video series. So we're using macroeconomic fundamentals to obtain a macro view on the stock market. And we're using microeconomic fundamentals to obtain a micro view on stocks and sectors within the overall stock market. When we put these two things together, when we marry the two, it gives us an edge in that we allocate dollars with confidence in our ideas and our positions. We take this approach under the assumption that we are operating, of course, in the optimal areas of the stock market to exploit volatility. And that was covered in the IPLT video series. So we understand which area of the market that we need to be in to get consistency and to get consistency in returns, okay? To become consistently profitable, we understand the area that we need to be in within the market, and then we use a process to generate the ideas and to generate those consistent returns. The quantitative process though, guys, obviously it comes with a bit of a expectation of educational understanding, okay? The quantitative process, it's mechanical, okay? It requires a lot of spreadsheet and data work. Similar to the IPLT video series, you're going to have to get yourself up the curve, okay? And it takes a while. It takes a while to learn this stuff and internalize it, okay? To get yourself up the curve, you're going to have to first learn how to obtain and process data. It's very important in the world of financial markets, very important in the world of trading, to become comfortable with data and statistics and processes to manage the data and processes. But additionally, you're going to have to learn how to understand and interpret the data, okay? So it's not just about mechanically doing it, it's about understanding and interpreting the data. In the PTM video series, you're going to be taught all of this spreadsheet work and how to process everything yourself. So you're going to be taught all of the processes so you can go away and do everything for yourself. You'll also be taught how to understand those processes and how to interpret the data properly, okay? That's very, very important. Very important skill sets for competent traders to learn, okay? This is going to be done with both macroeconomic and microeconomic data. So you'll be able to locate interesting potential long and short stock ideas for the rest of your life. And most importantly, doing it for yourself, okay? Now, there is a caveat. The quantitative process is simply the first step to generating an actual trade idea, okay? You saw earlier that a trade idea is not a trade idea or can be defined as a trade idea unless it has all the elements that we covered. So when you go through a quantitative process, please note, we use the word potential, okay? At that stage, you don't have a trade idea. The next stage you have to go to is the qualitative assessment. You also need a timing assessment. You also need to look at optimal trade structuring. And you also need to understand about how you're going to manage your risk of that trade. It's an entire process and an entire plan. Okay. Everything's going to be fully explained later in the video series. Here, I'm just giving you an overview of the framework itself, so you understand every single step and every single element of the framework and what constitutes a trade idea. The next step, qualitative assessment. Qualitative processes and assessment, okay, as part of the overall trade idea generation process. So when we're looking at fundamentals to generate trade ideas, we do not just stop at the quantitative phase, okay? We don't just do quantitative assessment and then stop and think we have a trade idea. We don't, okay? We don't just use the mechanical processes utilizing the data in the spreadsheets. We also engage in a qualitative process to assess the quality of a company, stock behind the numbers, okay? What we do in the qualitative process is we find out what's driving the performance of the company and its valuation, whether it's good or bad. Just knowing the numbers is not good enough. If we're going to have a position in a stock, long or short, we have to know why we have a position. The most important reason we do this is to have a deep understanding of what is going on behind the scenes in a stock. What is driving the valuation? What is driving the fundamentals of the stock? Okay. So imagine you have the position on and some qualitative information comes out while you've got the position on. What's going to happen? You're going to be able to interpret that information correctly. Okay. If the trade goes wrong, you will know what to do with it. If a trade goes right, you will also know what to do with it. We're not trading blind. We understand what's going on beneath the hood, not just in the spreadsheets and in the numbers. We know what's going on qualitatively beneath the hood. Okay. The qualitative process is an essential add-on to the quantitative process because it deepens and furthers our understanding in a stock and gives us higher conviction in our positioning. What does that mean? Well, our higher conviction in a position comes from a higher understanding of what the qualitative factors are that are driving a stock's fundamentals and valuation. This is what gives us a major edge in the market. Okay. This is what gives us an edge over other market participants. And it is edge that we need in order to make superior returns within the parameters of the market where we get optimal volatility. Why? Because the vast majority of market participants will never do the work. They will never dig as deep as we do and have a deeper understanding of what's really driving a company and driving stocks valuation. Next is timing. So we've generated an idea, what we think is a good idea. It's got potential. We've been through the fundamentals. We've been through the quantitative and the qualitative processes. And we decide we really want to have this position. What's next? Well, it's timing. We've been through quant and we've been through qualitative assessment. However, even at this stage, we've not yet obtained fully what can be described as a trade idea. What we've got at this stage is a bias, okay? We've obtained a bias, a long or short bias on an asset, on a stock. Now we have to time the trade. Once we have our timing and we understand that it's in play, it's ready to go, and we have our additional stuff like trade structuring and our risk management plan, that is when we have a trade idea. So at this stage, we use technical analysis, TA, and price action, PA. We use those indicators to help us time trades better. And occasionally we use those tools for some risk management practices if it makes sense to do so. Now, at this stage, if we conclude that it's the wrong time to put on a trade, we wait for a better time. It's not a trade idea yet. Okay. All we have at this stage is a bias. If it's the right time to put on the trade, we think it's the right time to put on the trade, we move on to choosing our optimal trade structure. So you can see we're going through the processes, and at the timing stage, it might be rejected as a trade idea because the timing is not right. If the timing is right, then we move on to trade structuring because it passes the next filter of the definition of a genuine trade idea. Now, we do not use technical analysis and price action indicators to generate ideas. That is for uneducated retail traders, brokers, and charlatan trading educators who are all operating at the level of unconsciously incompetent. Okay. TA and PA is useful, but it has its place in an overall pro-trader systematic process. The place that it has is only to help with timing and some occasional risk management. Okay. Don't put too much weight on technical analysis and price action indicators. There's so much weight put on TA and PA by the unconsciously incompetent. What it essentially does is it keeps you there at the level of unconscious incompetence because it's the blind leading the blind. People misuse it. And there's multiple reasons for that are covered in the IPLT video series. But it is not, TA and PA is not for generating trade ideas. It helps us time fundamentally driven ideas. Fundamentals give us our bias on an asset, so a stock. Fundamentals give us our bias, long or short, and it gives us a potential trade idea with edge. Technical analysis and price action indicators help us in timing the trade. That's all they do, guys. Okay. So don't put too much weight on it. It does not generate a trade idea. Now, if we believe at this stage that we have our fundamentally driven bias, we've got our timing, things are starting to look good for our trade idea, we move on to trade structuring. Trade structuring is done around catalysts, okay? Time horizon and volatility are the two main constricting parameters in trading. We, as long-short portfolio managers, are operating in the 1 to 3 month time horizon, and we're placing ourselves in that volatility sweet spot that we covered earlier. In the IPLT video series, viewers watching now, you will have understood that for us to optimize these opportunities, we require wholesale opportunities to enable consistency. Every position that we take, however, must also present further opportunity, so potential volatility, above what is already priced in by the market. And for that, we absolutely require catalysts that are going to occur within the 1 to 3 month time horizon while the position is live. Okay. Now there's going to be much more on this later in the PTM video series. For now, just try to understand the framework. Okay. Around catalysts, we build trade structures. Okay. We seek to optimize the trade structure around the idea within the 1 to 3 month time frame. And that can be additional to just simply going long or shorter stock. Okay. There's multiple trade structures utilizing mostly equity options that we can consider. And that is mostly covered in the POTM video series. One of the biggest mistakes of retail traders in the stock market is to think in the following terms. When you're looking in the stock market, retail traders think that a good company automatically equals a good stock, and that automatically equals a good trade idea. That is a very bad habit and a very bad way of thinking. Okay. It's just completely wrong. What usually ends up happening in these situations, the stock ends up not even moving within what can be defined as a trading time horizon. And then it ends up becoming an investment. Okay. We do not operate with this mindset. We want to make money in the 20 to 60 day time horizon. We require catalysts and we require trade structures that optimize those catalysts within the time horizon. This is what constitutes a genuine trade idea. A good company does not necessarily equal a good stock for a trader, and it does not necessarily equal a good trade idea. It's just the wrong way to look at things, guys. But retail traders fall into this trap time and time again. So again, guys, just to hammer it home, because we need to iron out all of these bad practices of retail traders, okay? In the framework, you have to understand, we are not investors, we are traders. We do not take positions in stocks and then sit around waiting for years to find out if we're going to be right or wrong, okay? We need catalysts. And from those catalysts, we build trade structures that optimize the payoff within the 1 to 3 month time horizon. The trade structure that we choose has to reflect the fundamentals, the timing, and the catalysts that we see occurring in the next 1 to 3 months. And as I've mentioned, there are multiple, endless potential trade structures that we can take advantage of to just simply being long or short a stock. So in options, for example, option structures are covered in the POTM video series. And when we look at advanced structures, unfortunately, advanced structures can only be done on a mentoring program. In the PTM video series, we're going to be looking only at long and short stock portfolios, okay? So we can't, obviously, in the PTM video series, when we're teaching you the framework and every element in it, go and become experts on options as well. Options trading requires an entire video series, okay? But what we will be covering is preemptive and reactive risk management practices on stock portfolios. That's going to be covered in the PTM video series. So again, the framework, guys, and what constitutes a trade idea, what constitutes a genuine trade idea is all of the elements. You need to cover all of this to be good at generating trade ideas. All of the elements need to be covered. Now, when you've been through the entire trade idea generation process in theory and in implementation, what's going to happen? You're going to put positions on and you're going to take positions off. It's really that straightforward. Positions will be winners, losers, or coming out flat or around flat. You're going to have to measure your performance. And for that, there's trader metrics and trader performance, okay? As traders, of course, we place ourselves in that volatility sweet spot and we expose ourselves to an abundance of high quality trade ideas. And we're aiming to get consistency. We're building the 1 to 3 month long short portfolios. When we're going through this whole exercise, we're going to end up placing many trades over a period of time. And initially, what you should be worrying about is your first year, okay? As traders, we must have feedback on our performance. Now, of course, making money is a great indicator. Most retail traders don't make money, okay? So just going in to the market with the right information, implementing successfully is making money, okay? But we need to get feedback on more. We need to understand how we're making money and what our strengths and weaknesses are so that we can improve incrementally over time. You know, coming from unconscious incompetence into unconscious competence and then becoming consciously competent, that takes time. When you're implementing, around 1 year is when things start to become statistically significant. But if you're just making money, coming from a long period of time where you've implemented all the wrong stuff, you've got the wrong information, you've implemented all the wrong stuff. If you're just making money, that's a great start. But we have to understand when we've booked a number of trades over a year or so, we have to understand how we're making money. And within that data, we're going to really understand what our strengths and weaknesses are, okay? Now, on the flip side, of course, if we're down and we're losing money, as traders, we want to understand why as well. Trading performance and using trader metrics gives you a comprehensive analysis of this, okay? And again, you have to interpret the data. So we have a comprehensive analysis of our trading performance that's provided by our trader metrics, and that measures what we call our track record. Our trader track record is the evidence of our performance as traders. And not just that, it tells us how we got the performance. It's essentially like switching on an X-ray machine and looking at the anatomy of a trader. In the PTM video series, what we're going to be doing is we'll be showing you all of the key professional trader metrics to measure your performance and track record, and how to actually understand and interpret the statistics so you can understand your strengths and weaknesses. You will be using these resources forever. You'll be tracking your performance, tracking your strengths and weaknesses, how you make money, how you lose money, interpreting it, understanding it, and incrementally getting better over time. So, getting a better understanding of this overall framework is absolutely essential as we start the video series. So when you move on, you've got the bigger picture understanding and the context of why we're doing certain things, okay? We're going to go through every single stage of the process. But when we do that, and when you're working for the rest of your life as a retail trader operating in the retail trading infrastructure, you have to level up your game, okay? You have to become as good as professional traders in all areas. Now, to do this, we're going to start you out on a path of ITPM principles. And these principles you have to stick to all the time. It's very, very important, okay, that you stick to these principles throughout. We're going to be sticking to extremely rigid principles, and they are simply non-negotiable, okay? Why? Because we know what makes a good trader, okay? We know what's required in the approach and skills, okay, that are needed to turn people into good traders. Good traders can't just be given the right information and then not the principles of how to implement properly and successfully forever, okay? There's multiple principles and other factors to consider that we're going to go through now. The first one is self-sustainability. And this is really to do with trade ideas, but it comes into other areas as well, okay? Self-sustainability is very, very important. You cannot be a consistently profitable trader for a very long time without being self-sustainable. Why? Well, good traders generate their own trade ideas. Good traders do not copy trade, okay? That is for dumb retail traders that are at the level of unconscious incompetence. You have to be a self-starter. It's non-negotiable. You must be a self-starter. In this video series and in other programs, ITPM are going to give you the tools so that you never, ever have to rely on anybody else, not even us. So you can stand on your own 2 feet. What do we mean by copy trading? Well, going on blogs, going online, looking at websites, joining chat rooms, turning the television on, going on social media. What you're essentially doing is you're copying other people's ideas and other people's trade ideas, and you're just following other people, okay? You're not generating your own ideas. So if you go on social media, for example, and you see a guy pushing something, They've come up with the idea. You haven't. You are copy trading. That's how it manifests itself in the modern world. Okay. That is not self-sustainability. If you're going to do, let's say, 1,000 trades over the next 5 years, 10 years, okay. If you take the approach where you're going to get your trade ideas for those 1,000 positions by going online and just copying people, I've got news for you. That's not going to work. That's for dumb retail traders, okay? Professional traders in all areas of the market, in all areas of the time horizon. Most of them are in the long-short portfolio management remit in the 20 to 60-day time horizon. But all professional traders are self-sustainable. They generate their own ideas, okay? In the 20 to 60-day time horizon, we're going to give you the tools to do that so you never have to rely on anybody else. Now, even a video series with the right information on trading, and even you taking that information and implementing successfully on a mentoring program with one of the ITPM professional traders, even doing that, it can only take you so far. Why? Because at some point, you are going to end up by yourself. You're going to end up alone. You'll be trading by yourself with no help at all from the big bad world. So how do you think you're going to get consistent profitability for your entire career? Well, it's not going to be looking at the next post online from some person that you follow on social media, okay? It's going to be because you're a self-starter. It's absolutely essential, and it is absolutely non-negotiable. Next up, work ethic. We get this a lot, especially from young people, young retail traders approaching ITPM. A lot of people want to become professional traders. A lot of people want to go and work at hedge funds, investment banks, etc. That's all great. It's a noble thing to want, okay? To have a successful career in the financial markets, okay? But it's not good enough to just dream and assume that you're a self-starter because you believe that you're motivated or passionate. You know, these words, passionate especially, and motivated, the currency of those words has been devalued so much over the last 25 years. People genuinely think because they have passion and motivation that they have work ethic and that they're self-starters. It couldn't be further from the truth, okay? We assume, obviously, that you actually want to learn here how to be a successful trader and that you're actually willing to put in the work. And it does take work, okay? It requires conscientiousness. And conscientiousness is way more important than passion, okay? At the Institute, we're not going to be spoon-feeding you trade ideas, okay? And we're not going to be telling you when to buy and sell stocks. That's for dumb retail traders at the unconscious, the incompetent level. As we outlined in the IPLT video series, there's an entire industry out there, a whole industry waiting to take advantage of laziness and the retail trader wish fulfillment for shortcuts and hacks. We don't do that at ITPM. We're going to give you the tools, but we need you to respond, okay? You need to respond with work ethic. And work ethic is conscientiousness, not passion, not motivation, okay? Try to eliminate those words from your vocabulary. Replace passion and motivation with conscientiousness. It's way more important. But guys, don't be scared of the work. We're going to take you through all of these processes. It's not as hard as you think. It just requires application and conscientiousness. Once you understand it, it's straightforward. And over time, your processes will get quicker the more you practice. The hard yards in this game are put in now. But it does get easier over time. So just stick at it. Next up in ITPM principles, free information. When you're starting out learning how to trade, it's important to get your hands dirty. Getting your hands dirty in the data to really understand the nuts and bolts of financial markets and how to interpret the data properly. At this stage, you absolutely do not need to pay for third-party software and incur expenses in an attempt to create shortcuts. Your interpretation of publicly available data is way more important than having a software subscription, okay? Think about it. What is the point of paying for software and data if you don't even know where it comes from? You don't even know how to understand and interpret it, and you haven't even turned a profit in your trading account yet. A software is not going to turn you into a profitable trader. Only you can do that, okay? You need to get, in the beginning, your hands dirty in the data to truly understand the nuts and bolts of this business, to understand the underpinnings of the financial markets. And you need to understand how to interpret it properly. No software can replicate those two endeavors, okay? It's very important at the beginning of your career to do that. You know, when we had graduates coming from university onto the Goldman Sachs trading desk, we knew that they had all the resources at their fingertips. We knew we'd be giving them amazing software, Bloomberg software, etc., and they would have access to amazing data sets, okay? But we also knew that they didn't even know where the data came from, what it means, and how to interpret it. So we made them get their hands dirty for at least the first 3 months, okay, in building spreadsheets, crunching data, and understanding all the processes and understanding the nuts and bolts of financial markets. It's absolutely crucial in the beginning stages of your development that you learn how to do that. We stick to the principle of free information. We look at publicly available data sets, and we learn how to process that data and get an understanding of the nuts and bolts of financial markets. One of the biggest secrets of the financial education industry is that it's totally possible to make money first with free information from the data by getting your hands dirty in the data and understanding the financial markets first. Why? Because they all want you to sign up for recurring revenue products like software, okay? A lot of this stuff gets sold to you as a shortcut and a hack, and gets sold to you as a panacea or a solution, okay, to your problem of not being able to make money. The software will never give you the answer, guys, okay? The software will just give you data that you can get elsewhere, but you can learn how to get your hands dirty in the data and learn how to interpret it properly, okay? You just have to be taught how to do it by people who know how. So professional traders, okay? Then and only then are you allowed to start subscribing to products that give you a quick answer, or subscribe to products that save you some time, okay? Then and only then are you allowed to go and spend money on third-party software and pay for data. And even then, only if it makes sense to do so. So at the Institute, in the beginning, we stick to this principle of making money first. You open your trading account, you put money into your account, and you make money first, implementing what you have learned in theory. And when you make money from it, maybe a small percentage can be spent on softwares later, not now, later, okay? So you start out with no resources prior to ever paying for anything. It's a very important principle because it has a lot of ramifications. It means it forces you to get your hands dirty, forces you to learn financial markets properly, and it forces you to understand how to interpret the publicly available free information. Okay. That gives you a fantastic fundamental crutch for the rest of your career. So you may not even ever need to pay for software. That's the beauty of it. So we stick to this principle because it's very important to start off your career getting your hands dirty from the free information. Stick to the principle of making money first from free information, never paying for anything. And then if it makes sense to do so in the future, then perhaps think about it if it adds value to your trading. Next up, working smart, not hard. Once you've actually done the hard yards of learning the theory, and then you move on to implementation, of course, this whole endeavor of trading in the same way that a professional trader does, but in the retail trading infrastructure as a retail trader, it has to fit into your regular weekly life. Now, earlier, we referred to work ethic, okay? And when we did so, we referred to conscientiousness, not passion or motivation. And certainly here, not the amount of hours you're willing to work per week. You can work for 50 hours a week on trading and not make money. You need to work smart, okay? You've got to eliminate the vast majority, the 97% of bullshit and noise in the market that doesn't fit your objective, that being consistent profitability. Very obviously, there is both a minimum and a maximum amount of hours that you need to put in per week. A good trader is a consistently profitable trader, and that requires you to show up every week to put in the minimum hours. But we have to be realistic. Retail traders are likely to have full or part-time jobs. They're likely to be running small businesses, for example. Retail traders can be at college or university. So you've got other things that you're doing in your life. You've got your family. You've got hobbies and interests. Okay. There's only so many hours in a week. Okay. Given your other endeavors and other considerations. So you need to also apply a maximum. Okay. When you're starting out, there's a minimum and a maximum. The minimum is obvious why you have it. Because if you're going to build a portfolio and you're going to trade it, it takes a certain amount of hours minimum to do so. But there's also a maximum that you have to apply. There is a diminishing marginal utility to working over a certain amount of hours per week on your trading, even if you're doing it to the standard of a professional trader. And you don't want it to affect other areas of your life. Why? Because when you're starting out, it's not a full-time job. It's a part-time endeavor. Essentially, trading, building portfolios when you start out is a hobby or an interest, okay? Slowly over time, as you make more money, you can put more time into it, okay? But your time starts off with a minimum and maximum, and you only put more in above the maximum if it's becoming an extremely profitable venture, okay? We're going to show you in the PTM video series how to optimize your hours and to work really smart, okay? So getting the most out of those hours per week, no dead time, getting the most out of those hours and being super efficient, okay? Principle number 4, work smart, not hard. It's extremely important to stick to this principle going forward. So starting out in the video series, try to internalize these principles and try to internalize all of the main parts of the framework and the trade idea generation process, and also what constitutes a trade idea. So let's add a few more elements to the Pro Trader systematic framework, the long-short portfolio management in the 20 to 60-day time horizon. So you'll see under theory and implementation, we've added a few boxes, okay? We've added volatility and opportunity set. this comes from the IPLT video series, okay? Strongly advise that you do it. It will give you a better grounding and understanding of what's going on in the PTM video series and help you with the overall process, okay? Under implementation, you'll see that we've added real money trading. That comes from you trading by yourself, so self-trading, or on an institute trader mentoring program. Self-trading can be done outside the institute or it can be done inside the institute, okay? But if you're inside the institute and you believe that you may need help with a professional trader looking over your shoulder, one of the guys at ITPM can help you over a 12-week period in the implementation phase, okay? Or if you're struggling in the implementation phase, you can choose to do a mentoring program later. You'll see that we've also added to the right-hand side after risk management, when positions come off. So we have the total process on the left-hand side flowing to the right-hand side. Obviously, positions go on and then positions come off, okay? What have you got when positions come off? Well, you've got your trader metrics and your track record. What is that? It's your performance as a trader, and you get that from statistical significance, probably over 1 year to 18 months with about 100 to 150 trades, something like this. That's when things become statistically significant and you start really learning what type of trader you are, what your strengths and weaknesses are, and whether you're any good at this, okay? And adding these boxes in is helpful because it gives you the context and understanding of the overall framework that we're trying to teach at ITPM. So moving forward into the PTM video series, we're going to look at every element, of course, inside the boxes and the trader metrics, every element inside the boxes and the trader metrics. The volatility and opportunity set is the IPLT video series, and real money trading happens with real money, either as an institute trader or outside the institute self-trading, or as an institute trader on a mentoring program. So we're going to go through all of the things from left to right: fundamentals, quantitative and qualitative processes, timing. Trade structuring happens more in POTM because that's with options, but we will do long and short positions in the PTM video series. And we're going to cover risk management as well in the PTM video series. So adding these boxes gives you a better understanding of the context. So guys, let's summarize a systematic process or framework in general terms. And I say in general terms because it's not just guys in the 20 to 60 day time horizon on the professional side of trading that utilize systematic processes and frameworks. They're utilized by shorter term traders. They're utilized by investors as well. What is it? In the broader context, a systematic asset selection process is just a process in which a trader or investor goes through a series of processes in order to find trades and investments that provide a higher probability of success when compared to simple randomness, okay? All professional traders and investors use a framework to select their positions. The vast majority of professional traders out there globally use one that's very similar to the framework that you're going to learn in the PTM video series. Now, the framework presented in the PTM video series is adaptable to any market, okay? You can tweak it. It's flexible, okay? It's not rigid. So you can take that framework into any market where you can trade publicly available assets. It's a very, very useful tool, okay? Now, at different stages of the framework, of course, you can choose to add your own processes, your own inputs that are additional to what you're learning in the PTM video series. It's totally acceptable, and we encourage you to do this. We obviously can't cover every single thing that's going to add value to a trader's life in one video series, okay? If you want to add stuff in to certain areas of the entire process, the entire framework, that's completely fine. It's totally acceptable, and we encourage you to do it. But a small caveat, it has to be in the spirit of increasing your odds of making money, okay? As long as that's the case, then absolutely feel free to add your own inputs and processes into the area of the framework that you think they should be applied to. That's totally fine, okay? So that covers the framework, guys. I hope you've got a better understanding of what a professional trader systematic process looks like, what the framework looks like at ITPM, and what we're going to be teaching you here in the PTM video series. Let's go back to the desk and move on to video number 2.